Welcome back. You're watching First Streets, and let's look at what's happening in the F&O market. The spot market holding flat at this point in time with the premium of 28, and that's the July futures because we are seeing a lot of rollover happening in the morning there. Open interest up in the July futures up nearly 4%. So. We were at around 50 odd percent. I think we are now heading towards 50-55% rollovers for July. Look at Nifty Bank again there. For the July futures, the bank index is absolutely flat, 0.15% down. But again, there's an open interest jump which is happening, because of the rollover which is there. Look at the Nifty Bank constant for the July series there, and if you see that, you're going to see that a lot of rollover which is happening for banks like HDFC, ICICI, Kotak, and other banks. In the HDFC Bank constituent. But open interest change for July 7 expiry, we're seeing good support coming at 24,000, call rating happening at 24,500 and 24,200, and that's what we were mentioning in the morning, that there is resistance for the market to go up, but on the other hand there's a support which is coming at 24,000. If you look at the distribution chart as well, that's what it gives you there. But from the gainers point of view, we have futures gainers 3.79% up for DRL. L&T Finance is up nearly 3%. L&T Finance is seeing a short covering. GMR Airport is seeing a long build up happening, up nearly 2.5%. On the losers, and you have stocks like Persistent down nearly 7.7%. Astral is down 6.3%. GVTND is down nearly 5%. Their open interest gainers will include you need to look at from a July point of view. So there is a huge buildup of open short buildup happening in Persistent, nearly 16% jump in open interest there. DRL is seeing a 8% jump, and BL is seeing a 6% jump. Among the losers, you have stocks like Force Motors, where there's a long unwind. Oil India is seeing a short covering, and JSW is seeing a short covering there. But most active in today's trade is Persistent, 4,500 July call. The premium down nearly 195.7. 3.5 lakh contracts getting added in open interest there. So the huge build-up which is coming for Persistent, the stock hovering around 44.63 levels. In the put side, you have HDFC Bank, 800 July put. The premium down 0.15, and addition of nearly 2.5 lakh contracts there. The stock hovering just below the 800 mark there. So overall, the market is flat, and we're going to see some volatility towards the end of the trade. So watch out for that, Aisha.
Oh yeah, absolutely. And since you're talking about Persistent, let's talk about the Nagaro deal. What's Persistent, of course, is going to achieve is a stronger European presence, auto, retail, manufacturing exposure. But let's ask Manas Human, the co-founder and CEO at Nagaro, as to what really was this deal all about and why now. Manas, great to have you on ET now. Thank you so much for your time. Can you hear me clearly?
Yes, I can. Thanks for having me, Aisha.
Okay, brilliant. All of us here are mesmerized, Manas, by the valuation that the deal has been struck at. But as a co-founder, I want to ask you, because I believe Nagaro's stock had fallen nearly 55% from its high to around 33.75 euros, if I'm not mistaken, before this deal. Persistent is paying all cash, and that equates to about 81 euros a share, and that's a significant premium right now that we're talking about. From your vantage point as a founder and a CEO, was this the right moment to sell?
So, the German share market is not very deep when it comes to IT services stocks. And we also have a relatively low free float. So small moves by a few investors would move the stock. So we have been at 212, we have been at in the 30s. So we have had a huge variation in the last couple of years. So I think that the fears in this about this whole IT services sector are overblown. And I think this is, ultimately it's a strategic move. I think it's a very powerful move to build this real AI first company. I think the stock market will see it eventually, but we have amazing logos and they have a great growth mechanisms and formulas for large deals, which we don't have, and we can just combine that. I think whether it's across geographies, whether it's across industries, whether it's across service lines or partnerships. We see such amazing, commonalities. I mean, not commonalities, but the complementarities that are. I mean, it just seems like a match made in heaven. So, from my perspective as a founder, I think the share market goes up and down, and that's what it does. But we are building value, and we've been building it for 30 years, and we have grown from a small company and gone 10x in the last 10 years, and we continue to do that, and now hopefully more powerfully with Persistent together as Persistent Nagaro.
Manas, morning, Sajid here. The persistent stock is down nearly 7% because of the kind of leverage it's going to take on his balance sheet. And the street is a little worried about the kind of growth that Nagaro has been clocking. Last year, it was around 2.8% on an organic, on a CC basis, around 6.5-7% that growth came in for revenues. Give me a sense of your business, because 60% of your business is time and material kind of contract. And that is subject to a lot of AI deflationary pressure. How is that business doing for you? And give me a sense of the kind of outlook you have for 26.
So let me tell you a little bit about this. So Nagaro has been a very differently structured company, a little bit cultish, really about engineering. So what we have really not had is a commercial mindset, to be honest, right? So what we expect is with someone like Persistent is the same sort of acceleration which Sandeep was able to bring into Persistent, because we never had, you won't believe it, but we don't set targets for business units, growth, margins. It's a very different kind of company. And over the years, it's obviously been changing and getting a little bit more, more traditional. But the whole, what we've been able to achieve with this is lean small teams working on really critical digital projects. Some of the brands we talk about on the website, but there are many, many more brands that we can't talk about. But we have clients that, literally marquee clients. We have 1,000 clients, and many of them are really marquee clients. And there's enormous room to grow. And the churn at the top 200 clients is barely a couple of clients a year. So we have like long-term relationships working in critical parts, but typically not in the large deal side. So basically in the part that actually moves the needle on the revenue side for our clients, right? So more digital transformation. And I think there's so many opportunities. The one is just to bring the large deals. I mean, you saw the Persistent deal that they declared, right? I mean, they have that huge large deal sort of appetite, right? To bring that into our long list of clients. There's also this possibility to, really just, just cross-sell all the services that we have. Like they don't have SAP and so on. So I think, and by the way, you just mentioned also this part about AI will make this T&M work less profitable. I believe the exact opposite. I believe the run side is much more at risk, because the run side, it's basically you run what you build. So whatever you've built in the last 5-10 years is what you run, and that doesn't change from year to year. But digital and build can change like it did in 2022 dramatically from one year to the next. So I think the AI transformation is actually digital plus in its nature. It's small teams. It's very engineering. So I actually think that is the more defensible side of the business, especially as COTS products start to get challenged and people start to think of building their own products. I think even right now the systems integration spend is about 30% and the digital engineering is only 10%. So even a small move from COTS products and systems integration into digital engineering, it would be a huge tailwind. So I actually think the whole intelligence transformation that's ahead of us is actually just fit for companies like Persistent and Nagaro. So I'm actually very excited. I think we are trying to build a leading company in this space, and I think we will be able to do it.
Manas, point taken, but can you give us a sense of the kind of AI-centric revenue that you have so far for at least calendar 2025? What percentage of revenues came from AI-centric deals as a whole? And the margin profile is slightly weaker than what Persistent has. So the street is also worried about the combined margin would be dilutive for Persistent.
So, AI today is at a very nascent stage. So obviously a lot of projects are using AI, maybe half are using AI in some way or form. But AI-centric deals, are basically it's still a lot of engineering around data, a lot of engineering. I mean, the whole, enterprise landscape, architecture, governance, security, data. These are all complex, large deals, and I think no large company has really gotten to the point where they're spending, this sort of transformation yet. They're doing pilots, they're doing different pieces, and of course these pilots, like if you have a forecasting engine as part of a S&OP process, there's obviously AI in many places in that, but I just feel that we are this metric that you're talking about. I find it very suspect. If you excuse me, but I think that really we are going to see AI everywhere. AI is like electricity. It's going to be everywhere.
Everywhere. But Manas, I think, what Sajid was really trying to draw was whether persistence acquisition solve a structural risk for you, or does it just give you a larger home?
No. So I think, we have basically feel that, for our growth story, access to this sort of good capital markets is very important. And we've been trying to do that for the last couple of years. We have been in this journey and trying to figure out how to get out of the market that we are in. The fact is that in 2020, when we were spinning out of Algar, we wanted to go to the US market, but basically because of COVID, it was much easier to list in Germany, but it's not the natural home for an IT services company, as you'll recognize, right? So we've been trying to solve for that, and now we're also trying to just take advantage of this fact that this is a really pivotal moment and gear up for the next AI transformation led engineering growth that we see ahead of us. We've done this actually, by the way. You can go back to the videos on YouTube, etc. 10, 20 years ago. We were talking about this digital sort of work, which is not pyramids but small teams and all the different distinctions that we are trying to drive. I think we're trying to do the exact same thing now for this intelligence transformation wave that's ahead of us. I believe in the next 10 years, every hotel chain, every restaurant chain, every airline, every healthcare, everybody has to rethink their tech for AI. And it has to be done, not just thrown in there with little pieces, but actually done with strategy, with security, with governance and landscape architecture, and run costs. AI is not free, right? So optimizing run costs, structural change. So I think the amount of work ahead of us on the build is enormous. And with the tools that we have, I think that the appetite for, if you look at your life in any day, you go to the hospital, you go to the restaurant, it's all full of these little frictions. You go to the airport. I believe all these frictions will go away with AI, and that's the play. The AI will, so the build that we will build is a lot more. That's what I'm saying, I guess.
Yeah, point taken, Manas. Manas, at the end of it, it'll be about how synergies play out between Persistent and you. And therefore, I believe that what we're trying to gauge is whether your margins can improve, and if so, materially, and what kind of timelines can one kind of build out with regard to that margin number. Because obviously Persistent will bring scale to you, you will bring your competence to Persistent, and therefore how should one look at margin shape up essentially?
No, that's a great question. See, I just point to one fact, and this is the fact that is very verifiable. We have not had a CFO. We just added a CFO a couple of months ago. So we are a company that has run, even as a listed company, without a CFO. We are not a company that was trying to optimize on margin. We were trying to optimize on just having a lot of great clients and doing a lot of great work with them. So that's the company, right? That's where we're coming from. And in Persistent, we see that same story a few years ahead. They started a few years ahead of us. And even in this, they were a few years ahead of us. They went from being a great engineering company and brought this whole sales power with Sandeep and his team and so on to play. And the commercial thinking, a little bit of commercial thinking. And that's kind of what we're trying to build. So I don't want to, steal Sandeep's thunder or Anand's thunder. I think that they will have to, we'll have to sit together and make those plans. But I think that there is a lot of room for margin expansion.
That should be a bit comforting. The other piece, Manas, is with regard to what and how quickly can the capabilities that you have be scaled up by Persistent. I'm sure that this was part of conversations when the deal was happening, or you would have a fairly decent kind of indicative timeline. as to how quickly can some of those services be scaled? Can Europe be scaled? Because that's a big presence for Persistent now, given this acquisition. How should one look at some of those levers?
Yeah, so the deal is not done. It has to go through the whole process and the approvals and all that. Right? So, but when that happens, you can be sure that on day one, we will be going to our clients and bringing the combined power of the two companies to bear, right? So we're really itching to do that. I mean, there are places, for example, they're doing, some modernization projects with banks, and we have some bank customers where we don't do that kind of stuff. So just the cross sell across different industries is incredible, right? So again, I know it's early days, but the motivation is very high because, as I said before, the complementarities are almost better than you could have designed, by even if you set out to design it yourself. It's just somehow surprising, but we just pick up two very different companies that hardly run into each other, but we have capabilities that we can really push into each other's funnels.
While this deal has an approval of your management and the board, and is good for the shareholders of Nagaro because the kind of premium that you get basis the current price that you have. How will you justify this deal to the shareholders of Persistent?
See, the value of a company doesn't change from the stock price. The company is the same company, and the stock price is a reflection of a large market, making its own expectations, etc. The company is the same company that it was when it was at 212. It has actually grown and continues to grow. So I think really that even if you sort of are positing a relatively slower growth in the overall market of tech, although I think that in the build side, it will pick up again and be dramatic. I think that the share price of Nagaro in the thinly traded with very low volumes and all the core shareholders holding on, I think that this doesn't reflect the true value of the company. And I think Sandeep and Anand are very canny people. I mean, they have very sophisticated finance people on their boards and in their teams, and Vineet and so on. So I think they have reached a very good balanced negotiation, and so I think it's a good. I think it's a great deal. Time will tell, but I think it's a great deal for Persistent shareholders.
Last question. You have a very distinct culture at Nagaro, flat, entrepreneurial, Europe-led, whereas Persistent is a very, very different beast, right? I mean, US-anchored, India-driven, now carrying this $1.6 billion in bridge loan to try and fund, close this deal. What's your honest assessment of whether or not there could be any integration risk? And where do you think it could really spring out from? For instance, 4 out of the top 5 European OEMs are your clients. I mean, someone would wonder, how can this client base be leveraged across both entities?
So, I think the first thing I'll just say that culture was among the first few sentences that Anand and I spoke with each other. Culture is very, very important. And you will recognize that for 99% of the people in Persistent and 99% of the people in Nagaro, we are engineers, and what we really care about is engineering culture. We are both engineering-led firms. I mean, I would challenge you to name 2 more engineering-led firms. There may be 1 or 2 others in other parts of the world, but in the Indian base, for example, I mean, 2 really engineering-led firms. And also, in Romania, in the Middle East, in everywhere that we are found, we're really engineering-led. So I think that is a very strong commonality. I think engineers like to work with engineers who work like engineers, right? And not like, in a more traditional services base. So I think that is the great power of the cultural fit. And yes, from an org design view, there are differences. But, we at Nagaro have done about 30 acquisitions and integrations. We are totally expert at that. We have acquired companies in the Philippines, in Japan, you can just name it, right? We've done that. And so we know how to integrate. We are probably the experts at integration. So what Anand and I discussed in the very first meeting, and Sandeep then joined us, is that that is going to be a key part of what we do. And you can be quite sure that Anand being a founder knows the importance of people. I being a founder and my founders like Vikram, Vikas, Manmohan, etc., all know the importance of people. And we will really know how to design this so that everybody feels really good. So yeah, it's obviously at a scale that is slightly larger, but we're also not in a hurry. What we want to do first is to bring our combined power to our clients. That's number one. That's priority number one.
Okay, Manas, wonderful having you here. Thank you so much for coming in, speaking to us very candidly. Really appreciate it.
Thank you. And we are meeting Sandeep and Anand now at our AGM. We have it today, and so really looking forward to that. Thanks very much.
Thank you, Manas. Thank you. All right, we'll sit on a very short break. Come back, talk to Mr. B. Thiagarajan, Managing Director at BlueStar, get some trends out of the way as to what's playing out in that side of the market as well. Also, crude has come off sense on the other side of this break. Thiagarajan, Managing Director at BlueStar, joining us this morning. Mr. Thiagarajan, great having you. It's been a tough summer. What's happening on the pricing front and on the volume front? Is it far better than what you were penciling in Q1?
Good morning, Harsh. It's a pleasure interacting with you.
Very good morning.
At the end, it didn't turn out to be a tough summer, so somewhat disappointing in terms of margins. Though the summer had set in somewhat late, it continued well till around 1 week ago. And I think the industry would have grown around 25% in terms of volumes and around 30% in terms of value. So I don't think summer is a disappointing one. But the disappointment is in terms of the margins. We couldn't pass on, and I don't think the industry could pass on the entire cost increase, which was to the tune of around 13% till May. I think somewhere around 5-6% only would have been passed on. That is the only issue.
Mr. Thiagarajan, I meant it as a tough summer from a consumer's standpoint because it's been extremely hot, right? And therefore, there is a need to kind of cool things down. But give us a sense, therefore. You said 25% on the volume side, 30% on the value side. But you've said something important there, that margins have been a possible problem. Talk to us about how quickly that unwinds. We've seen crude come off quite sharply. Does that unwind for you? And in terms of pricing, have price hikes been far more than pricing in a $72 on crude? Have price hikes priced in $85, $90 on crude? How should one look at those two trends?
There are multiple angles. Number one is connected with the prices of the metals, copper, steel, aluminum. This is one part. Second part is connected with the exchange rate. Summer pressure partially was offset by you had imported material ahead of the season. Now you are importing at much, much higher cost because the peak of the cost escalation coincided with the summer season. That is the issue. Whether this will be corrected, I think it will take another 3-4 months for it to correct. The festival season has to set in, and it depends on the festival demand. I am not very sure how the consumer sentiments will be. We are not able to conclude that the war is over, everything is good now, the growth will continue. I don't think we are in that stage. We are keeping our fingers crossed. The lost margins to regain will always be very difficult. It can happen only with an extraordinarily great festival season.
Hi, morning, Sajid here. So the probable impact on the margins is going to be around 8% because of the 13% cost. You've been only able to pass on 5 to 6%, and the volume value differential is only 5%, which has gone up for you. what could be the kind of margin impact that you're talking about, and if you're not able to recoup that margin impact?
No, that doesn't work that way. What I'm saying is the cost increase is around 13. Some 8% would have been passed on in our case, and some 5% will be balanced. But you do optimize certain other costs. I have indicated all along, I have been saying this. This may result in an operating margin drop of around 2% in that segment. That's what it will translate to as of now. But still few more days to go. We don't know how the June will end. I don't have the figures. And therefore, this is the real thing. You know, in a great summer season, normally it will be a double-digit operating margin, somewhere around 10%, which may drop by 2 to 2.5% is my concern.
What is the kind of inventory levels that's been carried at the dealer levels at this point in time? Are they in 30 to 45 days of inventory, or is it come down as well?
It has come down substantially. I don't think inventory is anywhere the issue at all. The one and the only issue is the cost escalation. One after the other that was happening, right? There was an energy label change. Obviously, the new designs will push up the cost. Copper, steel, aluminum, exchange rate. So this all continued. And remember, you start buying material and begin building the inventory in December itself. So therefore, later the time, you would have incurred higher costs. So the weighted average material cost will result in some kind of margin erosion. It will be at its peak in Q2. And some more price rise is not ruled out. We have to increase the prices. And somewhere around March, you had the LPG issue, you had the plastics and petroleum-based inputs, whichever is there, those costs have been going up. It has not softened yet.
So, Mr. Tyagarajan, if you look at FY27 as a whole, you're going to see a good volume growth coming in, but margins will remain pressured largely for the entire year, given the fact that you still have uncertainty of West Asia?
It will be too early to say that what are the other positive things that are going to happen. I do not know. I do not have the visibility. When we are in a crisis, we always imagine everything to be, in a bad shape. I suppose some good things also happen in the second half of the year. My view is that, I have been saying this, there is intense competition, the market is growing, and this growth is over the last year. Last year was a bad year. The important part is whether 19% CAGR for room air conditioners will continue. My hope is it will continue. Whether the price corrections will take place, it will take place. It may not take place immediately. It will take time. Now, the operating margin outlook, which in the beginning of the summer, I had stated that it may be between 8 to 8.5. If you ask me now, I will say 7 to 7.5 for the full year. That's what is my guess and some estimate. But we have to verify this in about 2-3 months' time.
Nagarajan, I'm also curious to know about the faster growing segments. And for you, one of those segments will be data centers and data center cooling. It's going to be a key raw material for AI and the AI play, and you're at the center of it. Give us a sense as to how strong is demand, how much of the top line will comprise of this segment in particular. Give us some color around metrics of how this particular vertical is shaping up.
Thank you, Harsh. Fortunately, we are not only a room air conditioner player. We have great interest and substantial presence in B2B part as well. So there are two segments which are doing well. One is the data center. The other is manufacturing, like the solar, EV, semiconductor, that part also is doing well. So as far as data centers are concerned, there are three parts to it. One is the MEP or EPC contracting part of it, where we are leaders. The market size will be 3,000 to 4,000 crores, and demand is unprecedented. And we will be having an order book of close to around 2,000 crores. We think that we will continue to grow in that particular part. The second part is the chillers meant for coolings, conventional chillers, where we have a strong presence, and I think the market size will be anywhere between rupees 1,250 crores to 1,500 crores. There is a third emerging part, which are the high-tech cooling or the contemporary cooling meant for data centers, like the liquid cooling, where we do not have a presence. We are in the process of finalizing our partnerships. And all put together, the outlook is around 20% of BlueStar revenue by FY29 will be from the data center segment. That's a sense you will get it.
And could you, so you've broken up the total market beautifully for us. What's your target in terms of market share in each of these?
In the EPC contracting part of it, we will have close to around 40% market share at the moment. And as far as the chillers are concerned, in data center segment, it will be 15 to 20%. In CDU part, which is a small one, the market size today will be anywhere between rupees 250 crore to rupees 500 crore. We do not have a presence there. We are in the process of finalizing the partnership. That will be a rapidly growing segment. This is where we are.
FY29, what is the kind of growth clip you grow by? What's the broad target? I know a lot of it is dependent on summers and the like, but is there a growth clip? Maybe 10%, 12%?
I think, I guess it will be somewhere around rupees 20,000 crores, let us say, minimum, and rupees 4,000 crore coming from data center segment.
Okay, thank you so much, Mr. Tyagarajan, for coming and giving us that. That's our headline, of course. 4,000 crore from the center alone, FY29. That's what we're penciling in. Okay, and with that, completely timed out on this edition of First Trades from Sajid, Aisha, myself, everyone who puts the show together. Thanks so much for tuning in. Stay tuned to ET Now, Midcap Masala, to carry all the action forward.
Warm welcome. You've joined us on Midcap Masala right here on ET Now. I'm Shesha Adwaryu, with me Snehi Shah, and clearly we'll talk about the markets in just a bit. Several mid-cap stocks continue to remain in focus, but first up, let's take you through all the top headlines that we're tracking at this point in time. Persistent Systems is down nearly 7% after announcing its €1.3 billion acquisition of Frankfurt-listed Nagaro, with investors reacting to concerns around leverage and integration risks. MK retained ad stance while Nuvama has downgraded the stock to hold, with brokerages highlighting execution risks, margin dilution and limited near-term upside despite the deal's strong strategic rationale.
Next up, watch out for Vikrant Engineering. That stock is doing very well. In fact, 9.25% uptick on that one because they won a 3,518 crore rupee EPC order from their subsidiary NOPL Solar Projects for a 969 megawatt solar project in Maharashtra. The contract is to be executed over the next year and marks one of the company's largest wins in the renewable energy space. We're going to be interacting with the management in a few minutes from now.
Meanwhile, let's also put the spotlight on Bansal Wire. The stock is soaring in trade, up 7% as we speak, after promoter Mrinal Mittal has sold about 3% stake to comply with SEBI's minimum shareholding requirement. The stake was acquired by marquee investors including HDFC Mutual Fund, Invesco Mutual Fund, BNP Paribas Financial Markets and Malabar India Fund.
On the flip side, Astral is under pressure after proving the demerger of its chemical business into a separately listed entity, Astral Chemi, while also merging subsidiary AI Al Aziz Plastics, into the parent company. Following the announcement, JP Morgan downgraded the stock to neutral from overweight and cut its target price to 1,450 from 1,780, saying the demerger is largely value neutral with very limited upside, and the stock is lower by about 7.25% as we speak.
Meanwhile, Hexaware Technologies is in focus as the IT services company has been named an Anthropic authorized reseller for Amazon Bedrock, enabling it to sell, integrate and support cloud models directly for enterprise customer worldwide. The stock is up 7.5% on the back of this.
And also watch out for Transrail Lighting stock doing well, up 2%. They have secured a 459 crore order of international EPC orders, primarily for transmission line projects in the MENA region. The win takes its FY27 order inflow to 1,034 crore rupees so far.
Let's put the spotlight on the stock of the day, and that has to be Vikrant Engineering. The stock is soaring in trade today, up 9.5% as we speak on the back of a big order. In fact, the company has won an order worth about 3,600 crore. Where does it take the company's order book position? To understand that in greater detail, we are now joined by Mr. Rakesh Markhetkar, CMD at Vikrant Engineering. Mr. Markhetkar, morning. Shesha this side. Thanks so much for joining us. First up, you won an order worth about 3,520 crore. This is from NOPL Solar Projects Private Limited. And you've said that it is likely to be executed over the next 12 months, which means some of this will spill into FY28 as well. How much revenue from this order will be booked in this year itself in FY27?
Good morning, Sesha. Thanks a lot for this show. The commenting on this new order book, see, we already started execution of this order. And though this is our internal NOPL Solar, we have taken 100% stake in 2 months back. And with this, we got our own order, and we will be executing around 1,600 crore of this order in this financial year. So though it is a 12-month the project, but 16 to 1,800 crore revenue will come from the project alone in this FY27.
Okay, so that sounds good, and that's the kind of value that you're looking for in terms of FY27. Also, talk to us about what is the outlook going ahead in terms of your order book position. If you can just give us an overall comprehensive number where the order book stands, and if you have any visibility on any projects in the offing, anything in the pipeline that could give you some visibility, let's say over the next 6 to 12 months.
Yeah, this financial FY27, we are planning to book a new order of 6,600 crore, and approximately 60% will come from the solar and 30% will come from power T&D, and the remaining 10% will come from the water and railway other sectors. Out of this 6,600, we already, with the Q1 itself, we booked net. Our booking for this Q1 is far better now. Apart from this, we have already some 2,500 plus crores. We are in the L1 position. So we are very confident of achieving our order book of 6,600 crores in this financial year.
So 6,600 crores of order book, that's the guidance for the full year. On the top line front, you had given a guidance of 2,400 to 2,500 crores the last time when we interacted with you. Now with this big order win, would you like to revise your guidance upwards, the revenue guidance that you had shared with us earlier?
So look, as far as the execution is concerned and our current guidelines, we wanted to maintain the same. Approximately 2,500 crores will be our revenue for FY27.
Okay, understood. And also last time you had indicated that you will become cash flow positive by the end of FY27. Are you on track for that?
Yeah, definitely.
Okay.
And we are all working in that same direction. And this good order book with the positive cash, the flow is the definitely reason to be the cash positive by end of this financial year.
Okay, so that's as far as revenue guidance is concerned. But how much of this revenue contribution will come from data center and smart metering business in FY27? We believe that you're already working in this direction, but how much of the revenue will be generated in this year itself?
So we are not counting any revenue so far in this financial year from the data center and the smart metering, though we have quoted around 2,500 crores the projects in smart metering and data center. We are preparing very strongly. We are started receiving the inquiries, but we have not got orders so far. So, but as per our guidance, we are working with the better profitable orders as we always do it. So we are talking and we are preparing for the data center order book. We have just counted FY27 100 crore approximately order from the data center.
Right. I wanted to ask you a couple more questions on the outlook, but I keep coming back to the order book number. Mr. Marketkar, 6,600 crore is the number that you've given us. With this order itself, you're at 3,500 crores. Let's say in the first couple of months of FY27, you've achieved half of your order book guidance. Any reason why we are not looking at hiking this further?
No, because we are already sitting in with good order book, and as I mentioned, approximately 2,500 crore. We are lowest bidder, and we'll be getting this in next 30 to 45 days. So now, since we work very as per our execution plan, we are not behind the order book. Our main focus is the execution. And then the execution is our main competence. So that for FY28 itself, we got a good order book now. 50% of that we are already in that position. We are not in hurry of further order book as of now for FY28.
Talking about execution, Mr. Marketkar, will it be evenly spread across all the 4 quarters of this year? You've given 2,500 crore revenue guidance. Will it be... please go ahead.
Yeah, sorry. So that Q3, Q4 will be around 65% of our revenue. So this is what trend for the EPC company and for the Vikrant is there. But FY28 onwards, with this good order book, we will be try to be in the evenly spreading across the quarters.
Understood. Mr. Marketkar, historically in the last 2 to 3 years, you've seen about 15 to 17% margins, which fell to 14% in FY26. Are we looking at 17% for this year? Somewhere around that, if you can give us a ballpark number.
FY26 will be around 14 to 16% EBIT margin.
I meant for FY27. Pardon me.
27.
Yes.
FY27.
Okay, so understood. So 14 to 16% is the kind of number that you're seeing for FY27. Also wanted to understand your plans. Any plan of foraying into the HVDC segment? Anything bubbling on that front?
So we have got the qualification for that because we are already at the highest system voltage execution at 765 kV. But now since that our major focus on high profitable, the solar and T&D orders. So we are not in hurry of HVDC in the particularly, though we get qualified for that. So let us see, we are keeping all our options open as of now.
Okay, and in one of your answers earlier, you did tell us that 50% of the order book for next year is already accounted for or already considered this year. What will your order book guidance be for FY28 in this case? 6,600 crore is the order book guidance for this year. What about the next year?
That will be around, in addition of 50%, 50 to 60% from the 6,600 crores. Because the FY28 approximately, if you see the CAGR of our revenue is average is around 35%. We would like to maintain FY28 onwards approximately in the same range. To cater that top line, we need to book around 55 to 60% additional order book for FY28. So we'll be maintaining that.
Okay, so about roughly 10,000 crore of order book. That's the guidance for FY28. Am I getting you right?
Approximately, yes.
Okay, understood. Thank you, Mr. Marketkar, for taking your time out and joining us here on ET Now and sharing your thoughts not only on the win, but what the outlook is for the next 2 years, and the stock is soaring high in trade today. Thanks so much for joining us today.
Thank you very much. Thank you. Nice.
On that note, we need to slip into a very short break. We'll talk to the management of NephroPlus in just a bit after this short break.
We were interacting with the management of Vikrant Engineering, and their guidance looks very strong in terms of their order book, 6,600 crores for FY27, and surplus of 10,000 crores for FY28 in terms of order book is what the company is guiding. But shifting focus from one management conversation to the other, we now have the management of NephroPlus joining us on the show. Mr. Rohit Singh, the Group CEO, the Group Chief Executive Officer of NephroPlus, joining us on the show right now. Mr. Singh, hi, morning, and good to be speaking with you. You know, your latest acquisition, 2 dialysis centers in the Philippines within 3 days. Talk to us about the rationale behind this, if this is a part of your structured roll-up plan for the market, and what are the opportunities that you're looking out for and your growth outlook for the Philippines market?
Thank you, Snehi and Ashesha, for having me on the show. Good morning to all of you viewers as well. So, as people might know, that NephroPlus is Asia's largest dialysis network. We operate in 5 countries. After India, Philippines is our second largest market. And we just crossed the 50 clinic milestone 2 days ago in the Philippines. And we have had 8 acquisitions in this financial year. We started this financial year with 42 clinics there. And now, as we speak, we have reached a 50 milestone mark. So this ties in with our strategy of going deeper in the markets that NephroPlus operates in. As I said, India the first and the Philippines second, and we slowly ramp up in every geography that we operate. We go deeper in that, and when we acquire an inorganic center like this, a already operating center, which we call a brownfield center, this ties in with our long-term strategy of margin accretive, stable state. And this the last center that we acquired in the Bataan province of the Philippines has close to 90 guests, what we call patients as guests, and doing over 900 treatments. So it's at par with any other stable center in the Philippines. So yes, we are very bullish on Philippines, and we continue to expand our footprints there.
Which other geographies, Mr. Singh, are you venturing into? Any other expansion plans globally?
So, as I said, interesting, and I've mentioned that in past as well, that, NephroPlus has 3, or any dialysis network typically has 3 levers of growth. One lever of growth is the same clinic, organic growth. The same clinic, the volume increases. Second is same geography, footprints increasing more clinics, what we've just witnessed in Philippines. And third, and the largest lever is opening a new market or having a large acquisition or a big PPP, state level PPP is the third largest lever, which typically is very unpredictable. The second piece, which is center roll-ups, is predictable. We can predict it on an annual basis. And the in-center volume is a quarterly, comfortably we can predict, given it's a chronic situation. So we are actively looking at 2 to 3 markets. We are already present in CIS, Uzbekistan. We are already present in Southeast Asia and Philippines. So both these regions we are looking at. We have we've been in Saudi Arabia for 3 years through a joint venture, and a new Ministry of Health tender has just come out, which would take few quarters to materialize. So we are actively working there as well. So Saudi Arabia remains our focus market. Over and above, we are looking at a couple of markets in the CIS and the Southeast Asia as well. But again, that will take time to mature and probably enter.
Okay, and understood. Mr. Singh, given the global supply chain and the forex volatility that we've seen this year, has sourcing of dialysis consumables or any machinery, has that cost pressure increased for you? And how are you looking at addressing this concern, if at all it is a concern for you?
So great question. I think no business have been not impacted in some manner or the other by this global and supply chain constraints that we all witnessed in the last couple of months. So NephroPlus, good part about being in the dialysis business is the demand has not got hit because it's a chronic, non-discretionary medical requirement. So the demand piece has not got hit, but obviously we've had our costing pressure on the consumables because of high dependency on PVC. But so we would expect we are witnessing a few basis point pressure on our margins. But I think going forward, given that stability could be expected in time to come, in Q3 or Q4, we should be back to our base. So there would be short-term pressure on the margins, not very significant, but yes, there will be, and we hope to get that even out by the Q3 or Q4 of this year.
Okay, and now with the two Philippines acquisitions that you have done, what is the total center count today, and what is the target for FY27? How many new centers do you aim to add?
Yeah, so we operate as a platform. We operate 345 clinics, close to 310 in India, 50 now in Philippines, 6 in Uzbekistan, and 1 is about to be operationalized in Saudi Arabia. So our plan is very clear that, as I said, we'll continue going deeper in the market. So in India, we hope to add 40 to 50. We sign new clinics in India. We hope to do 12 to 15 new clinics in Philippines in this year, and I think we are on track with that comfortably. We already done 8. So we'll continue adding around 50 to 60 clinics in this year, which would translate to a 15 to 20 CAGR in next 3 to 4 years on the revenue front. So I think what we had kind of committed earlier, what we had given guidance earlier, we are on track of getting there.
Right. In terms of your CAGR guidance, the revenue CAGR guidance of 15 to 20%, you reiterated that. But I'm a little curious about the center addition guidance. Basis the last interaction, I believe your number was at 40 to 50%. You're hiking it to 50 to 60 centers. Pardon me. Is that correct?
No, so it would be in the range because I'm saying this is the gross addition. There could be 1 or 2, shutdowns if that comes in, but largely the gross addition would be in the range of 50, 5 give and take here. Because as I said, this is not a very predictable on quarter. Few signups, few things get delayed. Few we are expecting to happen now, but may take a little longer. So it is on a year basis we can predict this second lever very comfortably, but it's very hard to say quarter. So that's why it's safe to assume we would be around 50 plus minus 5.
So that's as far as center addition is concerned. But let's also talk about top line growth, because at the end of fourth quarter, you did tell your investors that you're looking and aiming for 15 to 20% top line growth on a CAGR basis over the next 3 to 4 years. Will you be able to achieve that kind of growth this year as well, despite everything that is happening on the geopolitical front? 15 to 20% revenue growth for FY27, is that intact?
Yeah, so as I said, given the geopolitical situation, our revenue pressures have not come, given the nature of business we are on. It's just the cost margin pressure marginally which has come. So revenue front, I think what we had committed of 15 to 20 CAGR on a 3 to 4 year horizon, because as I said, there would be few market entries that could be or a lumpy one big project coming into which swings the needle. So we are very confident to deliver that on a 3 to 4 year horizon, which we had said during our Q4 results as well. So we maintain that stance that we are confident on that.
Sounding good over there, Mr. Singh. You did mention margins. Any visibility if FY27 margins could cross 20% this time?
Yeah, so I think on our last financial year, we were at a 23-24% margin. So we would be in the similar range on a year basis. As I said, there is little pressure for this quarter given the consumables, but I hope to get that corrected in the later part of the year. So net, we would be on the similar range is what we expect, but we'll see as the time proceeds.
I think safe to say that the second half could be more optimistic in terms of financials compared to the first?
Yes, we are a growth company, so obviously every quarter is expected to be better than the previous one. So I would want to maintain the same trajectory and then hope that our H2 is better than H1. So that's the expectation. And given that, as I said earlier, also with more stability coming in the global space, we would be more bullish on the second half.
We did talk about your expansion in the Philippines market, but what about Saudi Arabia? Because I believe you are looking to venture into that as well. And last time when you spoke to your investors, you did tell them that perhaps the first clinic in Saudi Arabia is likely to be commencing in the next 2 months. Has that happened? What is the progress on that front? And what will the expansion strategy be in the Saudi market?
So again, great question. Saudi is a very different market from our existing markets that we are operating on, and because health is a state subject there, it's typically driven by a tender market, like a tender market, typically driven by the tenders through various ministries, and Ministry of Health being the biggest ministry which kind of controls the health there. So we entered 3 years ago through a joint venture there with our partner, which again is a listed company, Tibia. And we started a clinic, and which was now got operating license, but there is a commercial license awaited, so it's in the licensing process. So we are hopeful that this clinic should be operational within next 30 days time period, and that would be the starting of our footprint in the country. But the major piece, as I mentioned briefly earlier, will be through a Ministry of Health and Ministry of Defense dialysis tender, which the EOI just got released, but then it has various stages of RFP and RFQ, which will follow in the next few quarters. So I think we would have visibility of the quantum of business in a couple of more quarters in Saudi Arabia. But our first footprint should be active in the next 30 days, hopefully.
Sounding very good on that front, Mr. Singh. Thank you so much for your time. And let's say in the next 30 to 60 days, we hope to interact with you once again. Thank you so much.
Thank you for having me here. Thanks a lot.
Thank you.
Thank you.
Viewers, with that, I'm afraid we're completely timed out on this edition of Midcap Masala. From Ashesha, me and the team that put this show together. Thanks so much for tuning in. But keep watching ET Now, because Buy Now, Sell Now is up next.